If you have been watching gold closely, then you may have heard a claim that sounds almost unbelievable. London has been at the center of global gold price discovery for more than a century. But now, something important is changing. The gold market is becoming more fragmented. Asian buyers are becoming more powerful. New trading and delivery systems are emerging, and China is pushing Hong Kong toward a larger role in global gold trading. This does not mean London has suddenly stopped setting the benchmark. It means the old structure of the gold market is facing a new challenge. And if you own gold or silver, then this shift deserves your attention. For generations, the London gold market has been one of the most important places on earth for precious metals. London became a major center because it had the vaults, it had the banks, it had the dealers, it had the connections, it had the infrastructure needed to move enormous amounts of bullion around the world. The system became so important that the London gold price became a global reference point for investors. The history goes back much further than many people realize. The first official London gold price auction took place in 1919. That means the benchmark has now existed for more than 100 years. But here is where the story gets interesting. The system that exists today is not the same system that existed 100 years ago. The old London gold fix is gone. The modern LBMA gold price operates through an electronic auction. ICE, Benchmark Administration, operates and administers the process. The benchmark is calculated through an electronic market rather than through the old-style fixing process. Gold is priced twice each day in London. The auctions begin at 10:30 in the morning and 3 o'clock in the afternoon London time. That distinction matters because the phrase "London set the gold price" can create the wrong picture. London does not simply sit in a room and decide what gold should be worth. The benchmark is produced through an auction where buyers and sellers interact. The process is electronic. It is auditable. It is independently administered. The benchmark is designed to reflect transactions between market participants. So, what actually changed? The biggest change is not that London disappeared. It is that the world around London is changing. For decades, the global gold market was heavily centered around London and New York. London dominated the physical over the counter market. New York became a major center for futures trading. Together, these markets created enormous influence over global price discovery. But gold demand is shifting. Asian markets have become increasingly important. China has become one of the largest gold markets in the world. India remains a major physical gold market. Central banks across emerging markets have increased their interest in gold reserves. Investors in Asia have also shown strong interest in physical bullion. That creates a powerful question. What happens when the largest buyers of physical gold begin demanding more influence over where gold is stored, how it is delivered, how it is settled, and potentially how prices are discovered? That is where Hong Kong enters the story. Recent developments show that China is working to strengthen Hong Kong as a global gold hub. A new physical gold delivery system known as Delivery Connect was launched between Hong Kong and the Shanghai Gold Exchange. The goal is to make it easier for physical gold to move through this financial connection. Reuters recently reported that China is also seeking to increase Hong Kong's role in global gold trading while reducing reliance on Western-dominated financial centers over time. This is not an overnight replacement for London. That point is extremely important. London remains enormous. Reuters reported that London cleared more than 16 million troy ounces of gold per day in May and held thousands of tons of gold in its vault system at the end of June. London and New York still handle vastly more gold trading than Hong Kong. So, why should investors care? Because financial markets rarely change in one dramatic moment. They change slowly. They build new infrastructure. They create new connections. They attract new participants. Then one day, investors look back and realize that the balance of power has shifted. That is the possibility developing in the gold market right now. Think about what a global gold market really needs. It needs trust. It needs liquidity. It needs physical storage. It needs accepted quality standards. It needs settlement systems. It needs banks and dealers. It needs buyers and sellers. It needs reliable pricing. London has spent more than 100 years building those advantages, but Asia is building them too. And that could become one of the most important long-term developments for gold. There is another reason this matters. Gold is not only an investment asset, it is also a monetary asset. Central banks hold gold because gold does not depend on another government keeping its promise. Gold does not require a bank to remain solvent. Gold does not have a credit rating. Gold does not disappear because a company goes bankrupt. That makes gold especially important during periods of geopolitical tension. When governments become concerned about sanctions, currency risk, sovereign debt, reserve diversification, or financial independence, gold can become more attractive. This is one reason central bank gold buying has become such an important theme in recent years. The traditional global financial system has been heavily dependent on the US dollar. The dollar remains dominant. US Treasury markets remain enormous. The Federal Reserve remains one of the most important institutions in global finance. But dominance does not mean permanence. Countries can diversify. Central banks can change reserve allocations, trade relationships can evolve, new financial infrastructure can emerge, and gold can sit at the center of that transition. Now connect this to the gold price. Gold does not move because of one factor. It responds to a combination of real interest rates, inflation expectations, dollar strength, central bank demand, investor positioning, geopolitical risk, economic growth, treasury yields, and financial stress. The Federal Reserve is particularly important. When interest rates are high and real yields are attractive, gold can face pressure. Investors can earn income from bonds and other assets without owning a metal that produces no interest. But when markets begin expecting lower interest rates, the calculation can change. If treasury yields fall, then the opportunity cost of owning gold can decline. If inflation remains stubborn, then investors may want protection. If the dollar weakens, then gold can become more attractive to international buyers. If geopolitical tensions increase, then safe haven demand can rise. And if central banks continue accumulating gold, then the physical foundation underneath the market can become stronger. This is why the London story cannot be separated from the larger monetary story. The benchmark is one thing. The forces that determine demand are another, and those forces are changing. Now there is something else that investors need to understand. A new gold hub does not automatically mean gold prices will rise. That would be too simplistic. A new trading center can increase competition. It can improve access. It can make physical settlement easier. It can create new arbitrage opportunities. It can connect different pools of liquidity. But price still depends on supply and demand. If the dollar becomes stronger and real yields rise, then gold can face pressure even if Asia is building new infrastructure. If global growth weakens sharply, then industrial demand can suffer. If inflation falls rapidly and monetary policy remains tight, then investment demand can change. So we should not treat this development as a guaranteed bullish signal. The bigger point is structural. The gold market may be becoming more multipolar. That is very different. For a long time, the global precious metals system had a strong Western center. Now we are seeing greater participation from Asia. That creates competition for influence, and competition can change markets. Silver makes this story even more interesting. Gold is primarily a monetary and investment metal. Silver has that role too. But silver is also an industrial metal. Silver is used in electronics. It is used in solar technology. It is used in electrical systems. It is used in specialized manufacturing. That means silver can respond to both monetary demand and industrial demand. If the global economy enters a period where investors want precious metals while industrial demand remains strong, then silver can become extremely sensitive. This is why gold and silver often move together, but not perfectly. Gold can respond more directly to monetary policy. Silver can respond to monetary policy and industrial demand at the same time. When the gold market changes structurally, silver investors should pay attention. Not because London sets the silver price in exactly the same way, but because precious metals markets are deeply connected. The LBMA also operates a global silver benchmark. The LBMA silver price is set once each day through an auction administered by ICE Benchmark Administration. This is important because the precious metals market is not one single exchange, it is a network. There are London vaults, there are futures markets, there are banks, there are refiners, there are mining companies, there are central banks, there are ETFs, there are private investors, there are industrial consumers, there are physical dealers. All of these participants interact, and price is the result. Now imagine what happens if physical demand becomes increasingly concentrated in Asia. Imagine that Asian buyers want more physical settlement. Imagine that more bullion is stored closer to those buyers. Imagine that new financial connections make it easier to move metal between different markets. You could gradually see more competition between pricing centers. That does not mean one market suddenly destroys another. It means arbitrage becomes even more important. If gold becomes cheaper in one market, then traders can potentially buy there and sell elsewhere. If gold becomes more expensive in another market, then physical metal can flow toward that premium. These flows help connect global prices. That is one reason it is so difficult for any single market to permanently control the global price. Markets constantly look for differences. Money moves toward opportunity, metal moves toward demand, and price differences tend to attract traders. So when you hear someone say that London controlled gold for 100 years, you should understand the deeper story. London became the center because it developed unmatched infrastructure. But infrastructure can be challenged. Technology can reduce geographic barriers. Capital can move. Trading centers can grow, and geopolitical relationships can reshape financial markets. This is exactly why the current shift deserves attention. Now consider the US dollar. For gold investors, the dollar remains one of the most important variables. Gold is priced internationally in dollars. When the dollar rises strongly, it can make gold more expensive for buyers using other currencies. That can reduce demand at the margin. When the dollar weakens, the opposite can happen. Gold can become relatively cheaper for foreign buyers. But there is another layer. The dollar is also the world's primary reserve currency. That gives the United States enormous financial influence. If global investors begin questioning the long-term direction of U.S. debt, fiscal policy or monetary policy, then gold can become part of the diversification strategy. This does not mean the dollar is about to collapse. That claim would be irresponsible. The dollar remains deeply embedded in global finance, but diversification does not require collapse. Even a small shift in reserve behavior can matter when repeated across many countries over many years. This is where central bank gold purchases become important. A central bank does not need to believe that gold will double tomorrow. It may simply believe that gold deserves a larger role in its reserves. That is a very different mindset from a short-term trader. Central banks think in decades. That long time horizon can create a persistent source of demand, and persistent demand can influence the structure of a market. There is also the geopolitical side. The global financial system is becoming more fragmented. Trade restrictions have increased. Sanctions have become a major financial tool. Countries have become more aware of the risks that come from relying heavily on another country's financial infrastructure. Gold can provide a form of reserve diversification. It can be stored domestically. It can be transferred physically. It does not require a foreign counterparty to remain solvent. That does not make gold risk-free. Gold can fall. Gold can be volatile. Gold can experience major corrections, but its unique monetary characteristics explain why governments continue to hold it. Now let's return to London. The important question is not whether London still matters. It clearly does. The important question is whether London will remain the unquestioned center of global gold price discovery for the next 100 years. That answer is much less certain. The modern benchmark itself has already changed dramatically over the last decade. In 2015, the old London gold fix was replaced by the LBMA gold price. ICE Benchmark Administration became the independent administrator. The new system was electronic and designed around greater transparency and broader participation. So the idea that the London gold price has remained unchanged for 100 years is not accurate. The benchmark has evolved repeatedly. That is actually the key lesson. Gold markets survive because they adapt. The first London benchmark appeared in 1919. The market later changed from sterling pricing toward dollar pricing. The old fixing process eventually disappeared. The electronic auction arrived. Participation expanded, and now new competition is emerging from Asia. The market is not dying, it is evolving. That distinction could be extremely important for investors, because markets that evolve can create new winners. Mining companies could benefit from stronger long-term demand. Refiners could benefit from increased physical flows. Vault operators could become more important. Trading platforms could gain influence. Asian financial centers could capture more business. London could respond with even greater transparency and liquidity. New pricing relationships could develop, and investors may eventually have more ways to access physical gold. Now there is one more question. What does all of this mean for the price of gold? The answer depends on the macro environment. If the Federal Reserve cuts rates while inflation remains elevated, then gold could benefit. If Treasury yields decline, then gold could benefit. If the dollar weakens, then gold could benefit. If geopolitical risk rises, then safe haven demand could increase. If central banks continue buying gold, then long-term demand could remain strong. But if the dollar surges, if real yields rise sharply, if inflation falls quickly, or if investors suddenly prefer risk assets. Gold could correct. That is why serious investors should never build a gold thesis around one headline. The structural story is powerful, but the short-term market can still move violently. Silver can be even more volatile. If gold continues to rise and industrial demand remains healthy, then silver could attract additional attention. But silver can also experience much larger percentage swings. That creates opportunity. It also creates risk. So if you are watching gold and silver right now, you should watch more than the headline price. Watch the dollar. Watch Treasury yields. Watch Federal Reserve expectations. Watch inflation data. Watch central bank purchases. Watch physical premiums. Watch futures positioning. Watch ETF flows. And watch what is happening to physical gold in Asia. Because these signals can tell you whether a price move has deeper support. There is also a major psychological element. Markets are driven by expectations. If investors begin to believe that global gold price discovery is becoming more decentralized, then that belief itself can attract capital. Financial markets often move before the underlying infrastructure is fully developed. Investors position for what they think will happen. That can accelerate change. This is why the next few years could be fascinating for gold. London is not disappearing. New York is not disappearing. But Asia is becoming harder to ignore. Hong Kong wants a larger role. China wants more influence over physical gold flows. Asian buyers already represent a huge portion of global demand, and the financial infrastructure is slowly developing around that demand. The result could be a more competitive global gold market, and that could be positive for transparency. It could be positive for liquidity. It could be positive for investors. But it could also introduce new sources of volatility. Different markets may experience different premiums. Physical demand may create temporary price gaps. Currency differences may become more important, and traders may pay closer attention to regional flows. This is the part of the story that many investors miss. Gold is not just a number on a screen. Gold is a physical asset moving through a global network. The price on your screen is connected to real bars sitting inside real vaults. It is connected to refiners turning large bars into smaller products. It is connected to banks managing inventories. It is connected to central banks building reserves. It is connected to jewelry demand. It is connected to technology. It is connected to futures contracts. And it is connected to the psychology of millions of investors. When the physical network changes, the financial market can change with it. That is why the London story matters. It is not really a story about London losing overnight. It is a story about the global gold market entering another phase of evolution. 100 years ago, London created a system that helped standardize global gold pricing. Today, that system has become electronic and independently administered. Tomorrow, the market may become more geographically diversified. That does not erase London's importance. It simply means London may have more competition. And for investors, that is the bigger story. If you own physical gold, then the most important thing is not to panic over every headline. Understand what you own. Understand why gold has value. Understand the forces that drive demand. And understand the difference between short-term price action and long-term monetary trends. If you own silver, then the same principle applies. Silver is not simply a cheaper version of gold. It has its own supply dynamics. It has industrial demand. It has monetary demand. It can react dramatically when investment flows accelerate, and it can become extremely volatile when markets become emotional. So the next time you hear that London has lost control of gold, do not assume that the entire market has suddenly changed overnight. Look deeper. Ask what actually changed. Ask who is building new infrastructure. Ask where physical metal is moving. Ask where central banks are buying. Ask how the dollar is behaving. Ask what the Federal Reserve is expected to do. Ask what real yields are doing. And ask whether the change is temporary or structural. Those questions will tell you much more than a dramatic headline. The biggest lesson here is simple. The gold market has never been static. It has adapted for more than 100 years. The London benchmark evolved. The fixing system changed. Electronic auctions replaced the old process. Participation expanded. And now new centers are competing for influence. That is not necessarily a warning. It may be the beginning of a more diversified global precious metals market. And if that transition continues, then gold investors should pay very close attention. Because the next major change in gold may not begin with a massive price spike. It may begin with infrastructure. It may begin with vaults. It may begin with delivery systems. It may begin with new trading connections. It may begin with central bank decisions, and by the time the price reacts, the structural change may already be well underway. So keep your eyes on London, but do not look only at London. Watch New York. Watch Shanghai. Watch Hong Kong. Watch central banks. Watch the dollar. Watch interest rates, watch physical demand, and most importantly, watch the direction of global capital. Because gold has spent more than 100 years adapting to a changing financial world. There is no reason to believe the next 100 years will be any different. The benchmark can change, the technology can change, the trading centers can change, the currencies can change, but the basic forces of supply and demand remain. And that is exactly why this story matters to every gold and silver investor watching the market today. If you found this analysis useful, then make sure you like this video and subscribe to Silver and Gold Watch. Your support helps this channel continue bringing you clear and focused precious metals analysis. And I want to hear from you. Do you think London will remain the dominant center of global gold pricing for the next generation? Or do you think Asia will eventually become a much larger force in global gold price discovery? Leave your opinion in the comments, and if you own gold or silver, then tell us what part of this changing market you are watching most closely. Stay informed, stay patient, and remember that in precious metals, the biggest changes often begin long before the headlines catch up.